Welcome back to Insights Out, Season 2. We're decoding the Web 3.0 economy. I'm Dr. Jen.
And I'm Maya.
So last episode, we floated a big idea, Bitcoin as digital gold and Ethereum as digital oil.
Right.
It's a great starting point, but today we're rolling up our sleeves to understand why their prices have captured so much attention. Like, what's really going on under the hood? A fantastic question, Maya. Let's start with the Bitcoin. When someone says new Bitcoin is mined, what does that actually mean? It sounds so physical for something that's purely digital. Right. Well, it's a perfect analogy for the effort involved. Bitcoin runs on a system called proof of work.
Okay.
Imagine a global digital lottery happening every 10 minutes. To enter, you need a specialized, high-powered computer. And your entry ticket is trying to solve an incredibly complex mathematical puzzle. So the first one to find the solution wins the lottery. Their prize? The right to add the next block of transactions to the blockchain, the official public ledger.
Exactly.
And they get a reward of brand new Bitcoin. These are the miners, the decentralized accountants of the network.
And this process is intentionally difficult and energy intensive. That immense energy cost is what secures the network. It makes it so prohibitively expensive for anyone to cheat the system that it's just more profitable to play by the rules. The security is literally baked into the cost.
Now, let's pivot to Ethereum, which it took a dramatically different path.
It did.
It also started with proof of work, but undertook this monumental shift. Maya, tell us about the merge. The merge was one of the most anticipated events in crypto history.
Right.
Ethereum transitioned its entire network from proof of work to a system called proof of stake. Think of it like changing the engine of a jumbo jet while it's in midair. So instead of miners burning electricity to prove their work, what do they do now? They don't. Now we have validators. To participate, you have to lock up or stake at least 32 of your own Ether coins as collateral.
Okay.
It's like putting down a security deposit. The network then randomly selects a validator to create the next block. So the security model, it shifts from computational power to economic incentive. You're proving you have skin in the game. Exactly. If you act honestly, you earn a yield on your staked ETH. But if you try to defraud the network, your staked ETH can be slashed, a hefty financial penalty.
Wow.
It's an elegant solution, and it reduced Ethereum's energy use by over 99%. And this fundamental difference in how they're created and secured, it leads directly to their unique economic models.
Right.
So, Dr. Jen, let's talk about Bitcoin's supply. It's the cornerstone of that digital gold identity. Absolutely. Bitcoin has a hard-coded supply cap. There will only ever be 21 million Bitcoin. Period. And the rate at which new coins are created is cut in half, roughly every 4 years, in an event called the halving. This makes Bitcoin a predictably scarce asset.
Right.
You can't just print more of it. It's that predictable scarcity that attracts so many people looking for a store of value.
Right.
But Ethereum's model is more dynamic, isn't it?
It is.
There's no hard cap. Correct, but this is where it gets really, really interesting.
Okay.
A major upgrade known as EIP 1559 introduced a fee burning mechanism. So now a small part of every transaction fee, called the base fee, is permanently destroyed.
Wow.
It's taken out of circulation forever. So think about what that means. When the network is buzzing, people are buying NFTs, using financial applications.
Yeah.
The amount of ETH being burned can actually be greater than the amount of new ETH being issued to validators. It creates this deflationary pressure. The more the network is used, the scarcer ETH can become. Exactly. And this brings us to the core of their value. Bitcoin's value comes from scarcity, security, and the trust that its monetary policy won't change.
Right.
It's a bet on a new form of money. While Ethereum's value, that comes from its utility. It's the digital oil that's needed to power the world's decentralized supercomputer. Every application, every transaction needs a bit of ETH as gas.
Right.
Its value is a direct reflection of the demand for its ecosystem. It's a bet on a new form of the internet. So, for our listeners who might be intrigued, how does one invest? The landscape has changed dramatically. For a long time, the only way was to go to a crypto exchange, convert your dollars, and buy the coins directly, which meant learning all about digital wallets and private keys, a big technical hurdle for many.
Yes.
But now there's a much more familiar path, right?
Yes, absolutely. The recent approval of spot Bitcoin and Ethereum ETFs has been a watershed moment.
Huge.
You can now get exposure through your standard brokerage account, just like buying a share of a tech company. It's a regulated, accessible bridge from traditional finance into this new digital asset class. So to bring it all home, we have Bitcoin, the digital gold.
Yep.
A potential safe haven asset driven by its unchangeable scarcity.
And we have Ethereum, the digital oil, a growth-oriented asset whose value is tied to the expansion of a new digital economy. Two different assets, really, for two different investment theses. And that leads us to a question for you to ponder. We frame them as gold and oil, a store of value versus a consumable commodity, right? But in a future that's fully integrated with Web3, could the lines blur? Could the fuel for the new internet also become a primary store of value? Could their distinct identities become even more defined? Something to think about. Join us next time on Insights Out. Yeah, where we'll dive into the vibrant and often controversial world of NFTs.